3, 2, 1.
All right.
Welcome, everybody.
June 23rd.
We're actually recording this on the weekend, which is rare.
It is rare.
I usually do it on Fridays, but my roommate...
Let's hope she's not watching.
She hates it when I call her that.
It was her birthday, bro. Come on, cut her a little break.
No, we had a birthday day all day yesterday, so it was great. But I'm a little foggy-headed, so
all right.
You guys don't judge me today.
I got some charts that'll make you think a little bit. So
it's gonna make my head hurt.
It might make your head hurt. It's made my head hurt all week. I am befuddled completely from this market, and I'm not the only one. But we're gonna talk about some pretty interesting things here, and I would not want to be in one camp or the other. I'm really glad that we respond to the market instead of try to predict it, because there are people staunchly on. It's like everything else in the world today. You're on one side of the fence or you're on the other side of the fence, and it's gonna go one way or the other, or not, or it can go sideways,
or not.
Right?
Yeah.
But yeah, we'll get into it. All right. So inflation we did last week. I found a new inflation indicator that I really like, so I'm gonna kind of go over that. Consumer sentiment. The Michigan, it's a survey that the University of Michigan does. It's been around for a long time. A lot of people really put a lot of faith in it, and it's telling us some really bizarre things right now. Bifurcation was the word of the week. Kind of like divergence, but even stranger. And then bonus chart Bitcoin, and then we'll look at the TSP weekly charts. So CPI and PPI are what we've usually talked about inflation, but there's a new company that came out and is doing this thing called Trueflation, and it's really, really good, and it kind of helps put inflation in general in perspective. So CPI, right, we talked about last week, it's what consumers pay, right? So what we at the end of the food chain basically pays for goods and services. CPI is based on 80,000 price quotes. So that's going to become important in a minute. 80,000 price quotes, they got 50,000 rental housing units, 23,000 retail establishments. So it's a survey. It's not direct data. And the way they put it out, right? This is the BLS, comes off the BLS site, and they put it out on an annual kind of basis, right? So, I mean, it's month to month, but they show you the 1 year. So all items, this is the consumer inflation, right? All items in May 23 was at 4%. That was inflation for the month. And then each one of these is, a new month where they take a data check. So we have been in this range between, 3.75 and 3% for a year. And, a lot of people are calling that sticky inflation. It's come down a little bit in the past 2 months, but it's definitely not below the lows. It's clearly within that range. So we'll have to see what happens, whether or not the Fed keeps rates higher. They like to talk about this one, because that is everything minus food and energy. And they like to use that one because it's trending down. But from our perspective, like at the grocery store or the gas station or wherever, just in general, everything, it's been flat for a year or in that channel. So that's consumer inflation. Producer price inflation is how much like raw materials and resources and stuff it takes to produce the goods that we buy. So what the producers pay, the inflation on them that's, theoretically gets passed on to us, right? So this is going back to 2010. This really annoyed me when I saw this chart. Going back to 2010, so just worry about the red line. It's the total. I'm not even going to worry about the blue line is less food and energy. But the red line is a total inflation for producers, right? And this is 1%. Okay, so it had a bit of a spike when inflation for us peaked at 9%. Inflation for producers peaked at, a little more than 1.5% maybe. And it's been in this range, and even, back here in 2010, like, it was relatively high, but it's been in this pretty flat range, and we're back to it. So what I'm saying is producer price index is not very high, nowhere near compared to, so the inflation that they're paying to make stuff is nowhere near.
That's what, I was getting ready to say. So let's back up a second so we can make sure we understand this. So if I'm producing products, right, I'm making stuff that you're buying.
Yep.
My costs, my inflation, right, has not really changed in 14 years, minus that, time there. That's during COVID pandemic. And
right. Everything tanked. So we had deflation basically in COVID, and then we had this inflation spike. But
so let's just take that out. Pretty much for the last 14 years, it's not really costing me anymore
to build stuff.
To build stuff, produce stuff, right? But why are we paying more?
Right. That's why I said this chart really annoyed me when I pulled it up.
But I just want to make sure we didn't glide past that, right? Because let's go back to the chart, right? And so just let that soak in for a minute, folks, because there's so many people that have so much, opinion about things, about why things are the way they are. Yeah. This doesn't tell you why.
No.
This doesn't tell you why it happened, but it's very important that you understand that based on the data that we're getting for PPI, it hasn't changed.
No.
In almost 14 years, or and except for the time during the pandemic, which is understandable. But that's a little troubling.
It is. This is the thing that kind of gets me. It came back all the way back to what the normal was. At the beginning of 2022. I mean, 2021. It was spiking. So that was, we were still not able to get stuff overseas, right? We were. It was like the peak, not the peak, but it was really well into COVID, and it's understandable, right? But once the supply chain got back online, and PPI got back to within like a normal range, it's been that way for the last 2 years.
Yeah.
And we're still yet
it's costing us more to buy things.
Yeah. So the third one.
Nothing to see here. Move along.
Yeah, right. The third one I think is really good. So I would highly encourage anybody that's interested, Trueflation.com. This is coming from a paper that they had on that site. I was going to do more of it, but I have a lot of stuff to go through, so I'm just putting up kind of the pieces of it. But remember when I said 80,000, the data set of 80,000 was going to be important before? So what Trueflation does is they're an independent company. They look at different sets of inflation data, right? So they're looking at taking it from 30 sources and 13 plus million pieces of services and goods. They're looking at a way, way broader data set than the BLS does to figure out inflation. Okay. The CPI looks at 80,000. These guys are looking at 13 plus million. Okay. And what they do is they look at 12 different categories. So obviously you want to know food and non-alcoholic stuff, right? Alcohol and tobacco. So basically they're looking at 12 different categories, and it's all the things that we use every day, as opposed to what the BLS is looking at. So they're looking at all these different things. In housing, they're chopping it up, basically. They're chopping up all these things and looking at inflation in all the different sections. So it's well worth taking a look at. This chart, I think, where the BLS puts out stuff, an annual chart, right? We looked at the one that showed from May of last year to May of this year. This is an aggregate, right? A cumulative inflation. So what is inflation actually? If a thing costs $1 last year, and this year it costs $1.10, if inflation goes up 10%, it's going to cost 11 cents more next year. It never goes down, right? You can decrease the rate of inflation, but unless you have deflation, it's always going to cost you more. So that means if you look at it cumulatively, which is what this chart does. It goes back to February, I think it's 21. Let me see. What is this, June? So, what's a good way to do this? 1, 2, 3, 4 years. So it's going back 4 years. So over the past 4 years, inflation, the cumulative inflation, is 25% as the way they figured it out. So that means everything is, the value of your paycheck is 25% less than it was 4 years ago, assuming you didn't get a raise, right? 25%. It's unbelievable that people are still managing at all, you know? And this, it can level out, right? If inflation is 0 for some amount of time, it levels out. We would have to have deflation for this to come down. So this line, yeah, it's flattening out here. It's the trend is always up. Extremely frustrating. Anyway, that's the bad news for the whole show. The rest of it is just befuddling. It might be good, it might be bad. I just don't know yet. Consumer sentiment. Okay. This is the University of Michigan Consumer Sentiment Survey. Okay. So there's no causation between. This is a survey of how people feel. Okay, it's consumer sentiment. They go out and they interview I don't know how many people around the country, and they get a feeling for how people feel about the economy. And it makes sense that people would not feel good about the economy while we're in recession. Okay? And a lot of people think that, you know, as this line comes down, it coincides with when we get a recession. So you can see the number starts falling, you know, before the recession begins. Starts falling right before the recession begins. And so you can read this as it's been falling. Like this was COVID. So of course, right, the sentiment index was way down. But then it recovered, okay, peaked, came down. This is the 22 bear market, so that makes sense, right? People aren't too happy about it. Came back up, but never, you know, certainly didn't get back up to the prior highs. So people are still concerned about the economy. And now it's just falling off a cliff, right? So now we're down here at 62.5. The crazy thing is this level is where we were, you know, almost at the bottom in 2008. So people are so pessimistic right now about the economy. So you look at this either as saying, people are so pessimistic, the market has to go down, right? Or you look at it and go, people are pessimistic at the same level as they were at the bottom in 2008. The market has to go up, right? How much lower can it go? And there's no recession in here, supposedly, anywhere.
Right. Yeah, I was going to point that out.
So I don't know. This is the first befuddling chart that I'm talking about, okay?
Yeah.
I don't understand. I don't see how sentiment can be so low. The market at all-time highs. Can sentiment just like completely go through the floor and price, you know, the market rolls over and I guess, I mean, in the realm of possibility, anything's possible, but it seems to me that
But we're looking at a market that's extremely oversold right now. I'm sorry.
Yeah, the S&P 500.
Right.
S&P 500, yeah.
Yeah. So we're I mean, there's a lot. And
actually, it's really only it's really only NVIDIA, but there's a couple of others that are keeping it up too.
Yeah, you have to kind of dig under the surface. That's why, like, I'm stuttering, is because I don't want to say this the wrong way, because it's not a general statement. You got to really pick away the layers, right? And that's really what Jerry's doing right now. If you guys can see, is we're just peeling back the onion to kind of get some sense of what's going on. And the more you peel back the onion, the less you understand what's going on.
That's right.
Because it's conflicting information, right? Things that normally, correlate, go together,
Yep.
or go against each other, right? They're inverses, are not happening like that right now. And so it befuddles a lot of analysts because we're used to being able to use all of this data to make decisions. And so one of the things I want to point out, which is important if you watch our show, is that if you really listen to us and you really kind of follow us, you know, our base theory is, like all technical analysts, none of this matters except for the price of what you pay, right? The price is what it is, and that's what matters. And that allows you to just focus on trends and patterns and things like that. Once you start getting into this macro world that we're talking about now, you shouldn't ignore it.
No.
But it's very hard to make decisions based on it, and more importantly, you just can't, right? What you have to do, we think, and it's not just us. I mean, this is the way a lot of analysts, even fundamental analysts, are still looking for trends. They're just looking at them in different places, right? So it's good to know why and how, but you're not always going to know that, right? The price is what matters.
Yeah. Price is the only thing that
Am I missing anything?
No. Like I said in the beginning, I would hate to be on one side of the fence or the other. Because if you just looked at this and you said, oh, clearly sentiment is so low, it can't get any worse. That means we're at a bottom. Price has to go up from here. I'm all in. Right.
Which is how people would have made decisions in the past.
Sure. And on the other side of that is, oh my God, everybody thinks the market's going to collapse. It's going to have to collapse because look at how low sentiment is. I'm going to cash, or I'm going to short. Worse than that, I'm going to short the market. Right.
Yeah. Now is so we keep saying this, and if you see our content going out, we say right now is not the time to be complacent. This is not the time that you zone out. If you're in the market, if you're not in the market, you can zone out.
Yeah.
But most people are in the market if you have a retirement account, unless you've moved all of your stuff in your retirement account to the G fund, or if you're in a 401k to your money market, like unless you're completely out, but you can't be complacent right now. No. There's just so many things going on. What you do is just watch this show and we'll keep you informed.
Right. I mean, it's not like we're in the middle, right? We're at extremes.
We're at extremes. Exactly.
And so something's going to happen. Okay, that's just the one chart. All right. But bifurcation, I didn't. Yeah. Okay. So this comes from actually somebody in the Facebook group late this week asked the question, which was a great question because it's all the stuff we're talking about on the show here. How can the fear and greed index be fear and the market be at all-time highs? Right? It's supposed to be, when the market's at all-time highs, we're supposed to be up here at extreme greed. How is it possible? And it goes exactly, it's the same as this, right? People are fearful. They have the sentiment is horrible. So the fear and greed index shows the same thing. It's just in a different way. Okay. So what's in the fear and greed index? Market momentum, right? It's the price. It's how high we are above they use 125-day moving average. So the further we get above that 125-day moving average, they call that extreme greed, right? So that's the extreme greed piece of this. Prices are high, okay? And like we say, price is the only thing that matters. Prices are high. Stock strength, okay? We're going to talk. I have a couple other slides about this, but net new 52-week highs and lows on the New York Stock Exchange. So if you take all the stocks that on the stock exchange that make highs, 52-week highs, and you subtract out the ones that make 52-week lows, this is what you get. Okay, this is what the chart looks like going back to July of 23. When price is at all-time highs, the number of stocks making 52-week highs minus the ones making lows is supposed to be higher, right? It's the ones making new highs should be increasing along with price. There shouldn't be more making new lows while price is going higher. So what is that telling you, right? There's only a handful of stocks. The other stocks under NVIDIA and Microsoft and Amazon, they're going down. Okay, so So I don't know that they've ever had this before. An extreme greed here, an extreme fear there, right? Bifurcation. Okay. Stock price breadth, McClellan volume summation index. So this basically is the volume of shares traded on new highs or new lows. It's very similar to the last one. When price is going up, this is supposed to be going up, not down. Extreme fear. Okay. And at the same time, the put call ratio is if puts if a lot of people are buying puts, they're fearful. They think the market's going to go down, so they're looking for insurance to make sure that if the market does go down, they're covered a little bit, right? When the put call ratio is way down here, it means there's no fear in the market. It's super cheap to buy insurance against the S&P 500 right now because nobody thinks it's going to go down. It's greed. It could be lower, and that would be extreme greed, but it's at a pretty high level right now, or put call ratio is at a very low level right now. Volatility, the VIX is it's neutral, basically because it's gone sideways. Anytime it's in these kinds of ranges, it's neutral, so it doesn't really affect the overall fear, the overall index. And then safe haven, this is crazy too. The safe haven demand is the difference between 20-day stock and bond returns. So when ordinarily stocks are more risky than bonds, right? So if people are buying, if the price of bonds is going up faster than the price of stocks is going up, it means people are buying bonds rather than stocks, and the implication is that they're more concerned about stocks than they are about bonds. It's a fear reading, right? And so it's saying fear because the difference is really pretty small, right, between stocks and bonds. It's fear index. Okay, this is the last one, and really how this is calculated, I think, is the most interesting. So junk bond spread, it's pretty similar to the stock versus bond spread. Junk bonds are really risky bonds, so you get a higher rate of return for them versus treasuries that are the safest bonds, and so you don't get much of a rate of return. So if the difference between a high risk bond and basically a zero risk bond, if the difference in the rate of return is really low, like it is right now, people aren't buying corporate bonds; they're buying safe bonds, and so it's showing a level of fear, right? Okay. So very few extreme greed, just the price and the put call ratio, which is amazing. Everything else is fear. Okay. So that's basically what the S&P 500 is right now. You got a couple of stocks that are driving the thing higher, and everything else is actually going down, flat to down. Okay. But the reason that this index overall is fear instead of greed is because how it's calculated. So the fear and greed index compiles those 7 different indicators, right? Market momentum, blah, 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 blah. Index tracks how much individual indicators deviate from their averages. The index gives each indicator equal weight. Okay, that's why the overall indicator is way in the fear column, because of the 7, only 2 are in greed and extreme greed. So if you looked at the RSP is a equal weighted S&P 500 ETF, it's going down. It's not going up. But the cap weighted S&P 500 obviously is making new highs because of a handful of stocks. So I'm going to get to the punchline in a minute. But this is showing Sven Hendrick on YouTube. If you guys want to go down the YouTube rabbit hole, sometime this week Sven did a show with Adam Thoughtful Money is the name of the, what's his last name? I can't remember. Taggart, yeah, Adam Taggart. So Sven is one of my favorite analysts, and he put up this chart it's just ridiculous. So market cap of the 5 largest companies as a share of the total S&P 500. So in 1999, when it was all tech, right, only 18% of the index was dominated by the 5 largest companies. In 2008, it wasn't really tech, and there weren't a lot of companies that were, that had nothing to do with why the market crashed in 2007 and 8, so it's not really part of it. But right now, when people compare the AI bubble to the tech bubble, it's way worse. 24% of the S&P 500 is 5 companies. I mean, it's at extremes. So what happens when those, if and when those 5 companies just correct? Forget about crash or anything else, just correct.
Yeah, I think that's something that gets lost too. These companies like NVIDIA and Microsoft, and they don't have to tank.
Nope.
They just have to kind of go sideways for a while, and the S&P and the rest of the market is just going to go the direction it's already
in.
It's already going down. These are holding it up, right? And can't lose perspective of that. You definitely can't take your eye off the ball.
Yeah. No, this doesn't necessarily imply that the market crashes.
No, not at all.
Just,
it could correct. It could go sideways for a while. There's a lot of things it can do. Well, there's 3 things it can do always.
Right.
Up, down, or sideways.
Yeah. Okay. This was the best chart. This is Sven. This is the most unbelievable chart. And it's kind of the punchline of this whole thing. The green line.
I don't understand the black backgrounds. I don't know why guys can do that.
I don't know why he does that either, honestly.
A lot of people do.
Yeah.
Go ahead.
I
Sorry.
don't like it.
I got distracted.
All right. So we're going back to 2005. Okay. Yeah, it makes the red look kind of weird on the pen too. The green is the S&P 500. The blue and red line there is the new highs minus new lows. Okay. So like we said on the other chart, when the index is going up, you expect there to be more new highs than new lows. If there are more new highs than new lows, this line goes up. Right? If there are more new lows than new highs, the line goes down. So while price of the index is going higher, you expect there to be more new highs than new lows. And when the index is going down, you expect there to be more new lows than new highs. And you get that all the way along. And it happens basically at all the peaks. They shift. When price shifts, it's because there are more companies making new highs than new lows. That's how the bottom gets created, right? More companies make new highs than new lows. And you see that all the way along until right there. So in 2022, the market peaks right there. We start getting more new lows than new highs. The market comes down, and we get to a bottom, right? The new highs minus new lows list continues down while price goes up from that 2022 bottom. And it does it until the end of December, till January, basically 2024. So how we got this rally, I haven't the slightest idea. When more companies are making new lows than I do know. It's those 5 companies.
Yeah, I was going to say, we do know.
Yeah.
It's just, it's not the answer you're looking for.
It's insane. Okay. So the reason he's got these big 3 question marks, right? Here's the punchline. I'm going to say one of 2. There's always a third, but one of 2 things is likely to happen here. Either the market is so oversold, right, that it's getting we've started having an uptick in new highs versus new lows in 2024, right, since the beginning of the year. So we have just begun this uptick after having pulled way back. Okay, so possibility number 1 is we are in the early stages of a huge move higher. And if that happens, whether or not the big five companies are involved in it or not, price goes up. The other possibility is that eventually price catches up with this thing coming down. So either we're on the brink of a monster rip higher, or the market pretty well crashes. I mean, I don't see it going sideways. I don't see how it can go sideways in this environment with things being so
and
in
especially
different directions.
in an election year.
Yeah,
where things are going to be one way or the other. So that's what we're looking at and honestly, I always hope for an up or a down market, not a sideways market. Those are the most difficult times to be in the market is when it's going sideways, because you don't really know it's going sideways until it's really in there.
Yeah.
So you think it's a correction. You think, you're thinking everything, but what you're watching is watching it kind of go sideways, bouncing like a little ball. And that's a very difficult thing to play, right? And so if you're in, you should stay in. If you're out, you should stay out, because it's just going to keep, that ball's going to keep bouncing along until the trend changes down or up.
Right.
And then if you're in, then you get out. If you're out, then you get back in.
Right.
It's a very difficult game to play for any analyst, anybody that does this.
So like I said, I don't think we go sideways. I think the market's set up for a big move one way or the other. You got Tom Lee talking about small caps doing a 50% move to the upside this year. So he's betting on this. He's betting on the fact that most of the market is so oversold right now, and it's just starting. The new highs list is starting to tick up. So he's betting that this keeps going, and the market keeps going with it. So it could be the let's go back to kind of what you were saying. This is the rest of the market. This is basically NVIDIA and a couple of other companies, right? If the rest of the market is really oversold, and we get a rate cut, rate cuts don't apply to companies that have a lot of cash. So these companies don't really get helped theoretically if we cut rates. But if rates go down, small caps can explode to the upside. So you could get the C fund flat to down, and the S fund ripping to the upside. You could get that. Okay. It's an interesting time to be an analyst. This is one other one that I put together. This is the McClellan oscillator. You can see when the market's going up, we're in the green. When the market's going down, it's red. Okay. The beginning, like big moves higher, you get really strong in the green. Where we are right now, price moving higher, and we are deep in the red. It doesn't make any sense. When price is going up, you're supposed to be in the green. This is a really good, usually a really good sell trigger when you come off of a high level in green in the McClellan oscillator and it crosses down to red. It's usually a great time to sell, which coincided with that down candle right there. Right, but then the market just turned right back around. But the McClellan oscillator is still super negative. It's just another bifurcation. This is the C fund in black and the S fund in orange. Okay, C fund they move up and down together. Usually, that's what we always say. We're generally evenly distributed between the stock funds because they all basically move up and down together. You don't know which one's going to move up more than the other on any given day, but they all peaked in April, right? They both peaked in April. Since then, the C fund has gone on to new highs. The S fund has gone on to new lows, which is consistent with everything else we've been talking about here, right? So the question is this pattern kind of setting up a base for the S fund to go higher, regardless of what the C fund does? Or is this downtrend, if the S fund gets below this low, it's going down, and probably the C fund is going down too, but it's forming some kind of base. So this is what it kind of looks like, the S fund, right? If it's in this this triangle consolidation, and this is it's a daily chart, but so we can't have this pullback in April. We've been kind of bouncing around, making this. We have a lower high, but now we have a higher low, which makes that triangle. And so next week, within the next week or two, it's trying to get support at that trend line. If it can keep moving higher, it needs to get above this before it's broken out of that triangle. But, if it comes up and hits here and comes back down and breaks through this one to the downside, it's going down. So the triangle consolidation is really helpful because you don't want to do anything until it breaks out one way or the other. But when it does break out one way or the other, S-Fund's going to tell us a lot. Okay. Bitcoin. So switching gears again. Obviously been a lot of talk about Bitcoin, not so much recently because people only want to talk about it when it's going up, but it had hit, so this is back to 2018, had that first really big peak in 2018. Big pullback and then a run up into 2021. So we got this high here at about 72. Pulled back, came up, tested 72, couldn't get above it. Came back, tested it again, and we're in this channel, right? We have to get above these highs, right? Otherwise, you're guessing. If you're in Bitcoin now, you're hoping that it breaks out, gets above that channel, and keeps on going. But it could just as easily, if it breaks down through that channel, we could get a significant correction in Bitcoin. It just hasn't broken out of the pattern. Okay, so if you look at it on a little smaller basis, this down here is volume. Okay, it's the number of shares that are trading hands in Bitcoin. When the price of Bitcoin is going up, the volume. So the green lines are volume on an up day, and the red lines are volume on a down day. Okay, so the first thing is just the height of this line in general. Forget whether it's red or green. When Bitcoin price is going up, volume is increasing. Okay, when Bitcoin price is coming down, the fact that volume is decreasing is a good thing. It means that people aren't bailing out of it, right? There's not high volume selling. So volume is decreasing as the price of it is coming down. That's good. But on this recovery rally, volume is horrible. Okay, it's just not. It's not like this kind of volume, right? So there's not a lot of momentum, like power behind this move higher, which is why it gets up to a certain level and rolls over. So it doesn't look like, and then we got prices come down quite a bit in in June, but it's relatively low volume selling. So it's possible that it's consolidating, and as long as it doesn't get below this low, if it gets below that low, it's back in the 50,000-ish. But if you're in Bitcoin thinking it's going to go higher from here, it certainly can. It's just that it needs to get, at least above 72, if not above 74, before it's likely that you can bet that it goes higher. And I always talk about the risk reward. So you can say that, well, I could buy Bitcoin down here at 64,000, and then it's going to go up, and because if I bought it at 74, I'd be missing out on this section here. You could do that, but there's nothing in this chart that would tell you that Bitcoin's going to go higher from here.
Yeah.
Right now.
You can gamble.
It's a gamble.
Yeah, nothing wrong with that, except it's gambling.
Yeah,
so just
because
know what you're doing.
There's nothing to tell you it is. But once you get back above the prior highs, right, and especially back above prior highs that go back here, right, we're in this channel. We need to break through that channel, and once we get above it, then you have a line, right? Then you have a reason. So say it's 74. If we get up here to 75,000, and you buy it there, you would sell it if it got below 74,000 again, because it was a failed breakout. So your risk, say, is $1,000, which on a percentage basis is really low for Bitcoin, right? Because you bought it at 74,000. So if it gets above that line, it's more likely to keep going higher because it's at new all-time highs. If it gets up there and then rolls over, it's just back in the channel, and you would just get out and wait for it to show that it was actually able to stay above that channel. So that line, once we get above it, we've broken through resistance. Now that line should act as support, which is why it's a low-risk trade at that level. Okay. All right, real quick, TSP fund charts. So C fund weekly, here's the bottom from COVID. I mean, it just keeps on going. This is the 20-week moving average line. We had a really good test at support there back in April, I guess that was, and C fund just keeps going higher. So if you're just looking at the price, there's nothing to see here. It just keeps on going. S fund, nowhere near its all-time high, and it's got lower highs, and it's fighting for support there at its 20-week moving average line. It's going to be pretty important here. If it gets below this low, the market's tanking. iFund has been trying to get back above this triple top at 82 for 4 weeks. Last week it got completely rejected, and then this week got support at this trend line. So iFund is at a critical place. If it's down here at 76, definitely if it gets below this level, iFund's going down too. But right now it's looking like last week it held support at that trend line, so we'll see. F fund, I've talked about it till I'm blue in the face. If you guys watched any of these shows at all, the F fund has come down in a 1, 2, 3, 4, 5. This is a monster bottom for bonds, and we got a 1, 2, and we just broke up through that downtrend line. So the F fund is the only really good looking chart that we have in TSP right now.
Keep an eye on it. And we'll keep an eye on it for you.
Yep. Yes, we will. A lot of stuff in there. If you like what we're talking about and you want to know when things change, sign up for the newsletter and the alerts and everything else.
Because we send out our analysis every week to our subscribers, way more in depth than what we go here in the show. The show is just meant to keep you guys entertained, hopefully a little bit, give you a little general market knowledge. But if you're managing your TSP account, whether you use our analysis or somebody else's, you need to be you need to be engaged, right? Active. Yep. Do it. Don't just sit back and listen to the people by the coffee machine. There's no coffee machines anymore. I got to stop using these old analogies.
People don't even go to work anymore, do they?
No. We just got a new coffee machine down the hall. It's pretty sweet. All right, guys. If you like what you see and hear, please share it with your friends. If you don't, share it anyway. Hope you guys have a great week, and we are
out of here.
Maybe.
How about there? We can stay.